All right, thanks, Tom. So as Tom mentioned, I'm Steve Duff. I'm the Chief Economist at the Ministry of Ag here in Ontario. Thanks for giving me the opportunity to speak to your group. We've done it several times over the last number of years. It's certainly, the sheep industry is an interesting one for a bunch of different reasons. And I'll touch on some of those points, I think, as I go through the presentation, and then hopefully at the end we'll have a few questions and some time to discuss things. So what I want to do basically is give you a little bit of a situation and outlook where we've been and where I see we could be going. When we do these types of presentations, we generally focus on a few different things. We always start with the United States. If you've heard me present market outlooks in other commodities, this included over the years, I think one of the key things is that we are a price taker to the US, and for the most part, everything except for about canola as a nation or as a province. And so, with that comes a number of wrinkles. The US market obviously sets things for us, and so we have to pay close attention to what's going on in their market. And again, depending on the commodity, and sheep is unique for a few different reasons, which I'll come back to, it's worth taking a look at. I'll look at the Canadian and Ontario market situation, and then I'll do a little bit of an outlook as to where I think things could be going for the next little while. So the US market situation. The US, as far as their base production units are concerned, has been in a gradual sort of state of decline. That's not uncommon, I think, in the North American context, whether we're talking about ewe flocks or whether we're talking about cow herds. I think in general, as far as beef is concerned, I think in general, the grazing industries are facing a lot of different pressures, including, the competitive pricing for corn and soybeans, the value of land, et cetera. And in the US, they've been seeing a gradual decline in that ewe flock, and it hasn't proven to be a particularly cyclical industry. They've been declining at about 1% a year, and there's some telling things about that. Some of that comes due to sort of the steady state of per capita demand, which I'll come back to around lamb and mutton. It has a lot to, again, with the pressures from a grazing perspective and sort of, where things rank as far as the various grazing animals and using grazing land, pasture land, hay land, et cetera, as an alternative for corn and soybeans in particular, and where the US sort of sits from a production point of view. For the most part, the United States, when it comes to meat production, has been setting record levels year after year for quite a while now. And a lot of that stems from significant export demand. The U.S. isn't a major exporter when it comes to lamb and mutton. They're an importer, and so that changes the dynamic a little bit in this industry relative to if we were having a conversation about beef or pork, as an example. So I'll come back to that a bit more in here in a little bit. What is the U.S. forecasting through 2021? So the story in lamb and mutton, I think, can be simplified quite a bit relative to, again, if you're talking about beef or pork, where Chinese demand in particular is almost insatiable at times, and that's having big driving volatility in a number of different things in the market. But I think that the lamb industry, the mutton industry, is quite a bit different. And one of the reasons is that you have relatively stable supply and demand. And that's continuing to be stable. It's not necessarily a growth industry, but it's not one that's on significant decline either. And so as a result, that does a number of things. One is that with that, you tend to see some fairly normal seasonality that doesn't typically get masked significantly by major changes. If you take pork or cattle, for example, in the US and even in Canada, when China takes on large amounts of export demand, when they're expecting to take on large amounts of export demand, that can really mask some of the seasonality that goes on in the industry. And that I really don't think has been as much the case in the US lamb and mutton market. And I think that translates into the Canadian side of things. Generally speaking, when you have relatively flat or sort of, smooth supply and demand, flat production, that can result in a fairly flat price over time, as well as a forecasted point of view. Now, again, market prices are very much a daily thing in many industries, or at least a weekly thing, depending on the nature of sales, et cetera. The information that's provided here is from the USDA, from their estimates, and from their quarterly information. The USDA tends to do, in a public sense, monthly information as well as some weekly information. And so it kind of gives you a little bit of a different flavor than if you were to look at individual sales from week to week, such as we do in Ontario or in other contexts. But, you know, I think in general, the stability within the US market translates into some aspects of stability in the Canadian market. What we've seen in the last little while in terms of the US is a fairly significant run up in prices, not unlike what we've seen in Canada in some respects. And so I'll come back to this in a minute, but we tend to look at the St. Joseph, Missouri price in the US as a base price. Over time, we've looked at San Antonio, Texas as well. But the price I use anyways is St. Joseph, Missouri. You could, again, go into some individual auctions if you chose to do so to provide a bit of a reference. But the forecasted price for the third quarter of 2021, so the quarter that's, you know, just ended now or is close to ending from a data point of view, is at a record level really from the US perspective. And a lot of that comes from some delays in the market, from some challenges due to drought bringing animals into the market. And that's played into a few different things I would suggest from the Canadian perspective, and I'll come back to that. With that, you can see that the import numbers basically through 2021, while they, you know, have been increasing relative to the last couple quarters of 2020, are still lower than that fairly high, almost record number at the start of 2020, in the first quarter. So, you know, again, you've got this bit of a balancing act that kind of goes on in the market. But one thing that has been, I think, unique about the way the US market has responded is that big jump in the third quarter of this year. And I'll come back to that in a bit as to why I think that's the case. In terms of the Canadian and Ontario market situation, you know, I think that there's, when you talk about the meat complex, you know, we have industries that are fairly self-sufficient. We have industries that rely significantly on exports like pork. We have industries like the sheep industry and the mutton industry here in Ontario, where there's, you know, fairly significant imports, etc. But there's a few underlying things I think that are important to remember. And that one is that the total meat demand is growing. It has been over time, largely due to population growth in many respects. When we start trying to look at per capita consumption of just about any meat product, there's, you know, not a lot of positives on the sign. Really, chicken's been the only one in the Canadian context increasing at that level. Now, again, some of this information is a little tricky because the per capita consumption numbers that we have in the Canadian and the US context are measured in the context of more availability as opposed to what people actually consume. They're not going out and measuring what you or I actually eat as far as lamb or mutton is concerned. They're going out and measuring production, overall consumption, exports, imports, stocks, and then calculating the difference. And so there can be some variability within that. But I think there's, again, some key things. One is that the lean protein has been rising, chicken being the major driver of that. If you look at the last 5 years, lamb and mutton has seen about a 1.7% decline in per capita growth. 2020 was flat relative to 2019. A lot of sectors saw a decline in 2020. Again, some of that due to some of the processing challenges that went on in Canada and the US in particular, and caused some real issues. And so, you know, at some level, I think 2020 was a bit of an anomaly year for a bunch of different reasons. But, you know, my expectation is that there would be some regrowth from that. If you look at the categories, though, for 2020, lamb and mutton and beef are really the only categories to see total demand growth. And so that's important for a few different reasons, in particular how that balances against the supply of animals that's out there. And so that's a pretty important piece of the puzzle in terms of this overall aggregate increase in demand. And again, because we're in the largest province, the province with, you know, the highest income, et cetera, that creates a number of market dynamics. If you've heard me talk about the meat industry in particular over time, I think that becomes quite important. You know, that said, obviously, across all of our meat complexes in Canada, imports are really important. You know, in chicken and turkey and eggs, we're supply managed, but we still import a fairly significant portion of our total consumption. In the pork industry, despite the fact that in Ontario we only need about 35% of the sows that we have in barns across Ontario to actually feed all of Ontario, we're still importing fairly significant amounts at points in time. If you look at Ontario, though, from a lamb and mutton point of view, we're importing over 100% of our consumption. And interprovincial wholesale movement is a big part of this. So we're bringing product in to Ontario. That, in combination with the strong production base we have here, is moving product into other parts of the country. And there's some important features within that, I think, in that one is that it does create a bit of a base from a processing point of view for the lamb and mutton industry. You see it in other commodities. If you take dairy as an example, I know it's supply management, but some of the products we bring into Canada for further processing, which we then re-export, are a strong piece of ensuring efficiency and scale in our food processing industry. And I think at some level, some of the imports of lamb and mutton into Ontario has been good for us from the perspective of helping our processors then have end product move across the rest of the country, which has in turn helped buoy them from a production point of view and help keep them efficient and further demanding Ontario product. I think that, again, if you look at the nature of how we import lamb and mutton, and if you look at how it sort of varies over time, I think there is some similarities to the supply management industry in that, it obviously is a large portion of what we consume, but it is also a relatively stable portion. And so as a result, it profiles a number of things, right? That, Ontario, we're a small importing country. We're facing low-cost competition, in particular from New Zealand and Australia. But that stability in volume suggests that we have a marketplace that is sort of comfortable and sees its domestic production as a strong part of the overall supply disposition compared to imports. And I think that's really important from the perspective of understanding where we can go with the lamb and mutton industry and how we can continue to fit in. And again, I think it's not necessarily a situation of, that we can't compete with Australia and New Zealand. It's more a function of how we fit into that overall function of the market. And I think, again, that comes into, the opportunity to, gradually over time expand market share as Canadians, demand fresher product and they start looking more from a local perspective. In terms of looking where retail prices go, we at the ministry track a number of retail prices for commodities that aren't easily available through things like Statistics Canada, etc. Lamb and mutton are one of those. So we track on a monthly basis. We used to do it weekly, but we've decided to do it monthly. It provides pretty much the same view to track monthly prices at several chains across Ontario for a variety of different products. What I'm basically showing here is for lamb chops and the average price over time. The red line represents an Ontario fresh price, which again, not all stores have fresh Ontario lamb depending on the time of year and again, depending on what store it is. The blue line represents the New Zealand price on a frozen per kilogram basis, and the Australian price is considered to be a fresh product as well. So you can see a few things. One is that we're typically about on average $9 a kilogram higher than Australian fresh. We're about $6 higher than New Zealand frozen. Over these last 3 years, the trends have been fairly consistent. We've had a period, as you can see, through about April 18 to July of 19, where the fresh lamb price for Ontario lamb was, excuse me, pretty close or even to those other products. And we had a distinct period starting in about July 19, where that's where the differential sort of went, and where again, depending on the market, between $5 and $10 different on a kilo basis over time. Quite stable from a pricing point of view. The other products have more volatility in them. So, there's some interesting pieces to that. And again, retail pricing is a difficult one to really sort of figure out where things fit into. Again, a product like lamb, where it's part of the meat complex. The meat complex is part of the overall protein, protein products that the store offers, and part of the overall, offerings of the store in general. And so they all sort of mix together, and that pricing formula comes into play in looking at those things. And one of the things we have seen in the Canadian context through COVID, I think for the most part, is that we have seen, despite, some examples where prices have increased, we've had a fair bit more stability in prices compared to the US in particular. And I think that's, played into, again, some of this competition that exists between retailers, and also some of the stability that our sector at the farm level has afforded in terms of continuity of production. So looking at Ontario lamb prices, obviously we have an industry that has some volatility to it. We have an industry that has a very active auction system. And so what we don't have is a futures market. So when I talk about this kind of thing, when it comes to the grains and oilseed sector, to the other livestock sectors, et cetera, we can use the Chicago Mercantile Exchange futures prices to give us a flavor for where the markets in the US would look at how things are going over the next little while, with a combination of exchange rates and sort of history and seasonality. We can kind of look and see where we think we're going to go. And so in the context of lambs, just like we do with other commodities, we'll pick a reference point in the US, again, knowing that we're a price taker to the US. And so in this particular case, we've been using St. Joseph, Missouri, and using it as a key reference price. You've got the choice lamb line for it since 2002 on a monthly basis under the yellowish line, and then the gray line is the Ontario price. And you can see, again, they're on a per hundredweight basis. There is a lot of similarity to it. If you run regressions through it, if you try to take a look at how that volatility plays, there's a close relationship there. And this comes down to the concept of basically, free markets. We have an open border with the US, so product can trade. We do have some trade in lambs, not in live lambs, not a ton, but a bit. At times of the year, we've seen some more recently into the Alberta market, and prices then do arbitrage to those markets to a large degree. And so we're able to use this as a reference. And if you look at the cattle industry as an example in Western Canada, they'll use Chicago futures, but they'll also use Omaha, Nebraska as a reference point as well. So you're always kind of balancing where product might move to and trying to understand how it arbitrages to those markets. In other industries, because we have such a long transportation distance to Western Canada, we tend not to look at that into Alberta, for example, with cattle or hogs. Well, there is comparisons, but not significant because of that large transportation difference. And so because of that, lambs, I think, does sort of disconnect itself a little bit from the US market. But again, St. Joseph, Missouri has provided a trend towards that. And you can see they both trended up recently. The Canadian market has jumped up higher from a difference point of view, a basis point of view, which I'll go through here in a second. And I'll come back to why I think that's been the case. If you look at the spread between the farm price in Ontario and the retail price, there's a few key things. And so, farm level volatility has not translated into processor or retail volatility. And, again, it depends a little bit on the sector and the commodity as to whether or not that's the case. If you look at the Canadian market for chicken, for example, the price of chicken is at the farm level is tied directly to the cost of production. And the quota period formulas that are used move fairly rapidly with the price of feed and corn, et cetera. So chicken, generally speaking, both in Canada, Ontario, as well as the United States, is one of the more volatile meat products at the retail level because of that sort of quick gestation period, if you will, and turnaround time from the birth of a chick to its ultimate processing as a broiler chicken. And so, in the context of other commodities, that isn't always the case. We don't always see, even in the beef industry, where there is fairly significant volatility at the farm level, it doesn't always translate into volatility at the retail level. And that's been the case, certainly, I think, in the lamb industry for a number of years. The graph on the left-hand side here starts in January of 2017, goes through to forecasted through to the end of the year. The blue line basically it's an index. So it just basically is designed to show the volatility in the price, not the absolute level. But the blue line represents changes in lamb prices over that period of time. And so as you can see, it's volatile, it's cyclical at a level, and that ties directly to seasonality and when product comes into market, et cetera. The yellowish line, the orangish line, that is a calculation, again, compiled by Statistics Canada, which basically measures the value of lamb as it's sold at a processor. Now, again, that's a little bit of a unique circumstance in the context of lamb, because a lot in Canadian context goes direct to consumer from the farm level. So this is a tricky concept, but you can see there's a bit of a lag to some of the spikes there. So when the farm price spikes, the the processing price spikes a short period of time later, but there isn't a great correlation there. And then the retail lamb price, again, cuts through that. And again, I think that's a function of the nature of demand, the fact that you're dealing with, at the retail level, fairly significant competition, obviously, from imports, an import product that's generally lower priced, that is filling a very large portion of the market. And so I think retailers have been very steady and steady-handed in that regard in terms of pricing lamb. And that has some benefits, I think, to the industry in terms of demand relative to other commodities where, you know, chicken, again, it's had high increases in per capita demand, but it's also correspondingly seen big changes in the retail side. In terms of looking at the spread, which isn't something we do a lot in the Canadian context, one, because the data isn't always great to do it, but the other is that the nature of our marketing systems are such it makes it, you know, kind of hard to do. What I've tried to do on the right-hand side is look at the spread between the farm and the retail lamb price here in Ontario. And so these are converted to basically the retail price and the farm level price are all on a live weight kilogram basis. So I've converted the retail price back to a live weight price as opposed to being a cut weight price. So there's a little bit of nuance within that, but I think in general you can see, you know, a few things. One is that there's a lot more volatility, obviously, in the farm price. That spread that the retailers have above the farm price effectively is increased after that, you know, jump in prices, you know, in the neighborhood of $10 or so back in July of 2019. That it has declined a little bit, obviously, as we've seen some of the increases in prices over the last little while, and it's expanded a little bit as we've seen prices flatten off in the last little bit. And again, I think that's going to play into some of the decisions at the processing and retail level here in Ontario and Canada over the next little while. And again, I'll refer back to that here in a second. So our flock size, like the US, has continued to decline. Again, I think it's a function of a bunch of different things. You know, pressure on from a grazing point of view, alternative cropland, you know, aging farmer population. There's a lot of different reasons, just like in the cow industry, why the herd has declined. We're the only province that's seen its flock size stay close to or increase from 03. I use 03 as a reference because of the BSE crisis. In 2021, basically at July, Canada, Western Canada and Ontario flocks all grew slightly. We had a modest increase of about 3% and about a 10% increase in breeding lambs. You know, again, I think it's a function of a few things. This is, again, a reflection of some stronger prices over the last little while. You know, outside of Northern Ontario, relatively good grazing season for the most part. And basically, I think that sort of optimism that comes with that. And so that 10% increase in lambs for breeding is going to be important in the next year or two as that, you know, will translate into increased production and hopefully some strong revenues for the sector. In terms of slaughter, again, the slaughter industry in lamb is again quite different in the Ontario context versus other commodities for a variety of different reasons. The main one being that the bulk of our slaughter is done at a provincial plant basis. In the context of in provincial plants and pork and beef, for the most part, slaughter is done on the basis of custom kills, direct to consumer consumption, etc., and you know, is a relatively minor part of the overall slaughter. So, you know, when we're talking pigs, we're talking about Sofina and Conestoga in Burlington and Breslau near here where I'm in Guelph. You know, they process, you know, 90-some-odd% of the total production in beef. It's basically Cargill and Guelph. But in lamb and sheep and mutton, it's a different thing. The provincial plants are about 81%. A lot of the provincial plants are buying the lambs at slaughter, which again is different than the context of the hog and the cattle industry. You don't have that. And as a result, I think I'll talk about it in a minute. There's some differences in the way in which the auction system, I think, responds to that. For total slaughter, it had been falling. We rose about 3% in 2020. That was despite some of the challenges that COVID created. Again, provincial slaughter was about 81% of total and had risen about 6% in 2020. Interprovincial live imports is a big one in a lot of commodities. It's a very, very difficult thing to monitor. It is not a measured statistic that's easily available. Well, it's not a measured statistic, first of all, like international exports or imports. We have estimates of it. Agriculture and Agri-Food Canada, Statistics Canada ourselves work on that kind of stuff, but it is difficult. It's imperfect, and one of the biggest challenges is sort of understanding what is that import. Is it a ewe? Is it the sheep? It's probably easier in the lamb industry. In the hog industry in particular, it's very difficult because of the various stages of the animal, from an iso wean to a weaner pig to a feeder pig to a mid feeder and then to market hog. And so there's a lot of challenges there. But we're down to a steady percentage of about, by my estimates, of about 30% of our total slaughter in Ontario being from interprovincial live imports. So again, that's going to vary a little bit. To date in 2021, that's up till the end of October, our overall slaughter, by my estimates, is down about 6% from this time last year. Our provincial slaughter is down about 4%, and federal slaughter is down about 39%. Federal slaughter being a relatively small portion of that. And you can see that relative to the lamb crop, which is increasing. So again, I think the big key here is that the provincial slaughter, while down, is only down a little bit. They've still got a heavy season of purchasing coming through. So, in my estimation, that slaughter capacity will be picked back up over the remainder of the fall and into Christmas, because that's where the bulk of the demand is. And again, I think that's one of the key things to think about when you think about the industry, is that demand that's created by provincial plants that, again, is completely different in the context of cattle or pigs. Well, in the pigs, you don't have a market hog auction where animals are purchased by processors for that purpose. In Ontario, we have a little bit of a fed cattle ring, over in Olex and Waterloo. There's a little bit of that anymore. If you go back to the BSE days, it was a more active auction, but it's pretty minor now. So there isn't really that gauge or that incentive there for it. Most sales from a slaughter point of view in those two industries, pork and cattle, are direct to packer, and so it is a more unique situation. And I think that has a big impact on this next slide, which is the basis. And so when we talk about basis in agricultural industries, the basic concept of the basis, you could use the term spread interchangeably. And the idea is you're looking at your current market and you're relating that back to some reference. And so, as I mentioned, with corn, soybeans, cattle, hogs, etc., most of the time our reference is Chicago futures, either looking at where things are today or where they're telling us the future is going to look. In cattle, I use the example of Omaha, Nebraska. That's a common one as well. But either way, you're calculating a basis. What is Ontario's price relative to that reference price converted into an Ontario equivalent? So again, when you're converting, in this case, I've got data here, the Ontario basis. This is all calculated relative to the St. Joseph, Missouri price over the last number of years. And so this is saying, basically, if you look at the first column of information there over top of J, which is for January, the yellowish line, that's the 5-year average. So on average, over the last 5 years, in January, the difference between the Ontario price of lamb and the St. Joseph, Missouri price of lamb, when that number is converted to Canadian dollars, so adjusted for the exchange rates, is about $100 per hundredweight. And so that's the normal basis at that time of year. And so normally when we do forecasting, we'd say, well, the basis this time of year is 100 over, it's 100 above St. Joseph. So if we were thinking St. Joseph was going to be X at this time of year, then we would think Ontario would be X plus 100. That's the basic concept. So that's that 5-year average. 2020, for January, you can see in February, that's the green line, was bang on. It was pretty much bang on to that 5-year average. So we'd say that's historically, it's historically consistent, et cetera. And as we move through March, April, May, June, July, we fell below that US price. And again, the reason typically being, when you fall below that, that tends to mean that relative to average, your local demand is a little bit weaker. In other words, there isn't that incentive in the market to bid up prices to have strong. So that can mean lower demand, it can mean higher supply, it can mean a bunch of things. And if you look at 2020, that is consistent with the start of COVID, some of the uncertainties that were created in the market. So people were paying less for Ontario lambs relative to the United States for a bunch of different reasons, some of which we were unsure. And as the year progressed, as we started to move into summer, as demand increased, and we started to get, sort of used to, if you will, the COVID environment and what it created, we crossed that line of the average. And for the remainder of 2020, we exceeded that historical average. So at the end of 2020, December, we were basically for that month in the neighborhood of $175 over St. Joseph relative to normally. With the cycle in the year, we're back to close to that 100 again on average. And so again, I think that was a reflection of a ramp up in when lambs come into market, a ramp up of demand as we started to normalize, as 2020 wrapped up, started to feel, that we had COVID at that point in time a little bit under control, and et cetera, et cetera. As we went into 2021, that's the blue line, we saw an even bigger increase. And I think part of that is stemmed for a few different reasons. One is that US prices started to move up and we started keeping that basis relatively similar. So, you can see, and again, in January of 2021, the blue line was 200. So we were 200 over St. Joseph at that point in time. Again, St. Joseph was rising. And oftentimes in markets where the base price has went up for reasons that aren't really related to the local price. So in other words, if St. Joseph's went way up because there were shortages in the United States that we weren't feeling here, oftentimes our basis would fall as a way to not reduce the price here necessarily, but to basically keep prices relatively flat. We've seen it with corn on occasions over the last couple of years where Chicago markets go crazy and the Ontario price, while it stays high, doesn't really jump up accordingly. And the reason is that people aren't going to drop the price here, but they're not going to pay, a continued massive difference between that and Chicago. And that's, I think, what's happened in the context of Ontario. We've seen increases in the US. We arbitrage to them to some degree. Again, transportation and movement in lambs is relatively limited, so it only arbitrages so far. But we've had that strong demand. We had that uncertainty and probably a shortage of supply from a packer and a retailer point of view, and stocks, et cetera. And they've caught that back up over the course of the year. And as we've moved into basically the middle of this year, into June, we saw prices start to fall to the point that our basis, as seen by the blue line, fell below average and fell quite a bit below average. In fact, into July, August, September, and October, we've been negative, which really isn't a normal occurrence in the Ontario context relative to St. Joseph, Missouri. That's not something that happens a lot in my experience and based on the data I've been tracking back quite a number of years. Again, in a normal circumstance, this would indicate that we have significant excess supply, that we are in an exporting situation because we're actually negative. We're not just lower, but we're negative to it. And so that's what actually we refer to as an export basis. Anytime you're positive to that reference price, it's an import basis. And so again, because we're a net importer of lamb and mutton, generally speaking, we'd be positive. But the anomaly right now, I think, is that we've been relatively flush with lambs from a demand point of view, and we're trying to sort of get caught up to this cycle of production, meet demand with a somewhat storable product, and then cycle that demand back through. And I think that's been one of the challenges we face. And because we have a relatively steady supply and relatively large lamb crop ahead of us, that's why the prices have dropped off. So as you can see into October, we're about $45 or $40 below zero, so negative to St. Joseph, Missouri. They're looking to flatten prices. So I'll come back to that in a second. But will we get the lines, the basis back to the to the green line like we saw through the remainder of 2020? I don't think so. I think we're going to be below. We might get back to that average line, which is the orange line, the yellowish line. But it's likely, I would say, that we'll see some extended pressure there. So from a market outlook point of view, again, this is where things get a little tricky, because when you start varying significantly from average, it's really difficult to know exactly what is driving that. I've outlined a number of things that I think are important in this regard, but I think that, again, this is where the dynamic of an auction does create some challenges, and because auctions carry with them sort of their own momentum. And auctions a little bit like the futures market, especially when the futures market has a lot of speculation in it. The speculation in the futures market can basically create momentum beyond what the regular sort of economics of the market would suggest are, and can drive you in a bear market, which is down, or in a bull market up, in ways that are kind of hard to predict. And I think that's a little bit where we're at right now in the lamb industry. We don't tend to have it in the cattle industry. The only two industries really in North America that have the bulk of their pricing on an auction basis would be basically, again, lambs, as well as feeder cattle in the Ontario context. And so I think that local momentum is pretty significant. It doesn't mean that you can't reverse things back. It just means that it has a tendency to take a little bit of time for the market to present itself. So again, I think that one of the reasons that lamb prices went as high as they did is some of the momentum that auction systems create. We're always starting out at a high price at the start of the auction. It only takes one, pretty keen bidder basically to get things going, especially with somebody that's bidding on a relatively large number. A good sized group of lambs goes through at the start of the auction at a high price, which might have almost completely been a function of the individual bidding at that point in time, and that can provide momentum for the remainder of the auction and potentially other auctions for that week and future weeks for a period of time. And you see that certainly if you look at the special cattle sales that have been going on the last couple of weeks, you see that in those markets. The first cattle sale, if it's really high, will have a driving impact on the remainder of those special sales over the course of a 2-week period in ways that are really a function, I think, of that type of momentum. And in many cases, similar people are the same people going to bid and whatnot. And I think that, again, is relevant in the context. So what it basically says from my perspective is that, we kind of have a bit of a range as far as where I would see lamb prices going over the next little while, into next and the end of next year. The blue line is where, if you were to look at the USDA forecast for St. Joseph, Missouri, which in my experience has been reasonably accurate over time, and you build in the 5-year basis, as I've talked about, that 5-year average, $100 roughly, depending on the nature of it, that gives you a pretty high price for the last quarter in 2021 and all the way through into 2022. End of 2022, right back to some pretty high numbers in the 350 range kind of thing. I don't think that's completely realistic, but it doesn't mean it couldn't happen. I think, again, it has a lot to do with sort of where the processing industry balances out against demand. And that's a really hard thing to sort of know based on where they're at. I think that the bottom end, sort of the lower bound, would be basically the blue and the orangish lines. The orangish line is basically the forecasted USDA price, again, converted to Canadian dollars, etc. And then the blue line is if the current basis continues. And the current basis is relatively flat, almost equal, if not just a little bit below, as I mentioned, the US price. And so, I don't know necessarily if that's realistic either. It would still be a reasonably strong price historically, but it would be considerably lower over the course of 2022 than what we've been experiencing for the last few years. So my guess is we're somewhere in between, but I think it provides a little bit of a bound for where I think things are going. But again, I think that the market fundamentals are there for strong prices. It's more a function of how the industry balances out some of those challenges that the meat industry across all parts of the complex have been experiencing. And so, we typically look at lamb production, and for the last little while, I've been using about $145 a lamb as estimated livestock and feed costs for that lamb. And so, again, the difference in returns is pretty significant, obviously, based on the lines from that previous chart. The blue line, again, being average, is a pretty strong return per lamb, over $145 of feed costs over the next little while. Again, I think that's probably not completely realistic. The orangish bar is probably a little bit pessimistic for a return, and if you get into the middle of the year, you're barely breaking even. You're not even covering your overhead costs if that's the case, which hasn't been the case in lamb for a little while anyways. I think we're somewhere in between, as I mentioned. And again, depending on the nature of your farm operation, the amount of cash costs you have, the portion of purchase feed, that kind of stuff. We all know that seed prices, fertilizer have been going up a little bit. Basically, fuel prices have went up a lot. Commercial feeds went up a lot. It's looking like fertilizer will be going up even more into the spring. So that's going to continue to pressure production one way or the other. And again, I think that where that pricing scenario goes is going to be a function of where things go quite a bit as far as the local demand is concerned. So just in quick summary, we followed the US in terms of numbers, in terms of prices. I think that the increases in prices in the US did temper things a little bit here, and I think it did put us on the, if you want to call it a tailspin as far as prices were going over the last little bit. We're seeing overall growth in demand, which I think is really key. And again, I think that stability of demand relative to imports from such low-cost competitors and such large volume competitors continues to be really important. I think the provincial plants in many respects are a very unique, strong part of this industry that you don't have in the other meat complexes from the perspective of them being involved in the purchasing, helping set prices, etc. You don't really have that in the other two sectors. And I think that's a really important thing, especially given that they're the bulk of production or the bulk of processing, I should say, and that there's a lot of them. So there's pretty significant competition there. You don't have that in the other parts of the meat complex, which I think is a bit of a challenge and a problem to some degree, depending on the sector. I think that prices will likely stabilize a bit. I think they'll probably come up a bit, and I think we'll probably be somewhere in the middle of those two lines, as I mentioned. Cost control in agriculture is always a paramount, in combination with continuing to improve productivity, which again, I know as an industry, one of your major focuses is productivity and lambs per ewe being a major driver of that, just like in the hog sector. So looking into those things continues to be forefront regardless of where prices go. But I think that that we should expect some stabilization, if not increase. But I don't think we should expect the kinds of highs that we've seen over the last year. But it doesn't necessarily mean there isn't room for optimism, especially if we're seeing some growth in production and relatively strong demand. So I'll wrap that up, and hopefully there's some questions and some comments. Thanks very much.
Perfect. Thank you, Steve. And I'm just going to remind everyone that we will take questions either through the chat box, or if you raise your hand, we will unmute you and we can take some live questions as well. So I'm just going to see here one question that's come in, Steve. St. Joseph versus Ontario prices closely correlated, but how do you tell if who's following who? Do Ontario prices affect the other way around or just one way?
Yeah, it's a good question. I think it first starts with who's the bigger producer. The US is a considerably bigger producer. So for the most part, they drive us. If your markets were much more local and there was a much more direct transportation link between the two, then to your point, the tail could wag the dog a little bit. But I think for the most part, it's St. Joseph, at least that level of correlation. Again, it is a correlation. It is something that can disconnect itself at times, something that there is arbitrage there. But because we have limited trade, it isn't the same as if you're in Western Canada and you're dealing with feeder cattle going into the upper Midwest. There's people that are moving cattle daily between those markets. That's a much different relationship. But I think in general, you could argue that it's St. Joseph here.
Perfect.